You often see messages like this on social media. Little known AI microcap jumped 100% in 5 days, and it's only just begun. The future of AI is here. And then they'll plonk in whatever ticker happens to be soaring to the moon. Now, just in response to some of these comments, little known will always be tied to small, and it's little known and small for a reason. So anything jumping 100% in 5 days is bad unless the value increased proportionally. So you have to ask, did an M&A event happen? Was there a great earnings call? What's the reasoning behind that price action? Rarely is it a good thing. This will usually be accompanied by comments like the train's about to leave the station. It's another YOLO FOMO comment you'll often see, which means absolutely nothing. And in reference to an AI stock, well, once everything's AI, nothing's AI. So what's the proof of AI? It always comes down to one ground truth, which is revenue growth. That's how you prove that you used AI to build some compelling product or service that people are willing to buy. Now, today we're going to talk about Poet Technologies. They're a nano cap, just on that edge. Maybe they've moved to micro cap. We'll talk about those definitions. AI stock that's shooting to the moon. But first, a little bit of pre-work. So I wanted to talk about why retail investors love small stocks. And it's a classic newbie mistake to read pieces such as 10 great stocks under $10. What's wrong with that statement? Well, the price of the stock has nothing to do with the value that you're getting. And when it comes to share prices, so there are downside rules. A company does not want its share price to go below $1 a share because that often triggers rules for delisting on major U.S. exchanges. So a healthy company will go public at an appropriate price, and then it will move upwards from there as it grows. Now, when it comes to upside rules, when a share price reaches a certain amount, sometimes companies split. Examples like Berkshire Hathaway didn't split. Now, these days, with this notion of fractional share ownership, where you can go to your brokerage firm, instead of putting 1 on the share, put 0.25 or 0.2 or whatever increment you like and click buy, and it will let you purchase fractional amounts of a share for no cost. So brokerage fees, thanks to Robinhood, brokerage fees are no longer exist really at most brokerage firms. So the price of a stock should have no impact whatsoever on whether or not you're purchasing shares of a particular company, and the smaller price is not a good thing. Still, retail investors always seem to, newbies anyways, let this arbitrary share price number influence their choices. That's because your brain is trained to pay attention to price. So some homework for the newbies among us. You need to understand these statements so much that they're intuitive. A $10 stock may or may not be cheaper than a $100 stock. You need to understand why. Having 10,000 shares or 1,000 shares doesn't matter. It's how much of the pie each share represents. I remember when I was a newbie investor going out and finding a microcap and buying a whole bunch of shares so I could say I owned thousands of shares in this company. That means absolutely nothing. Now, when those statements do become intuitive, you're going to start looking at low stock prices with suspicion, as I do today. Experienced investors, institutional investors, don't touch that stuff. It's just not on their radar. Similarly, small market caps become a concern. So not only low share prices, but small market caps. These aren't an opportunity. They're more of a threat. And people often say, well, a company that small has value because it will be acquired. Well, that comes down to this notion of intrinsic value. What's this money-generating machine really worth? So let's say a company has a market cap of $20 million. It's a very small amount of money. It could be easily acquired, right? You could pony up $40 million and shareholders would probably be happy for that premium and say yes. So anyone could own that company for $40 million, but nobody wants to. Why? Because the intrinsic value of what's out there isn't worth more than $20 million. And the efficient market hypothesis, something they teach you in finance, tells us that this company or any company has all available information priced in. Now, let's say the rhetoric starts ramping up and suddenly it's the next NVIDIA. Shares double in 5 days. Well, the advantage for the company is that they can now raise capital easier. So they're most likely to start selling shares and getting some cash from those overpriced shares. But what are the odds that they've created twice the amount of value for their shareholders in 5 days? Very low. So if a company then generates capital quite easily, that isn't a good thing either necessarily, because they haven't done so well so far. Why do you think that raising all this extra money is going to help get them somewhere quicker? And this comes down to a fund of my hopes and dreams business model versus a investment in a proven growth business. Now, when it comes to market cap, we don't invest in companies that have a market cap of less than $1 billion. That's a hard and fast rule. And then you can see here the different buckets that we invest in when it comes to disruptive tech, from small to medium to large to mega. So ideally, we like to invest in the large bucket. But there are other classifications that are not so common, and you can see them detailed here. So I think these fairly accurately portray market cap cutoffs. We used to build these at MSCI. The reality is they're dynamic for indices to adjust for market action, right? So, and to adjust for the country you're calculating them for, right? I remember manually calculating Pakistan's market cutoffs. It was a nightmare. So here you can see microcaps classified as $300 million market cap or less, down to $50 million. I think that's probably pretty commonly accepted. Then you have nanocaps below $50 million. We don't, in our Discord server, discuss microcaps and nanocaps because there's so much rubbish out there. And when you look at, people use the term small cap interchangeably, but what they need to do is distinguish between those two buckets, because here you can see where somebody has taken their portfolio, broken that down by size, and small cap can mean a lot of different things. But what it doesn't refer to are companies as small as a microcap or a nanocap. So we asked AI what it thought about nanocaps, and of course it parroted back total bullshit. So it said, they have the potential for some of the biggest returns in the market. That's incorrect. So you're simply confusing the size with the potential size it could be relative to successful companies. It says there's a higher potential to change price quickly, higher volatility. That's not a good thing. And it talks about a larger ROI if the company becomes profitable. Well, you say here there's a great risk associated with nano cap stocks. Right. Many of them shouldn't even be trading. There's a lot of junk there because they're not overly scrutinized by the SEC. There's just some downright garbage out there. So for any company, regardless of its size, if you don't have meaningful revenues, you don't have a viable business. And you see companies become publicly traded through back doors without having proper revenues. Now, before we start talking about Poet, I just wanted to ask you to support our work, please, and subscribe. We're going to be putting out a piece very shortly on how to get to 100K for all the newbie investors out there who've asked for it. So stay tuned for that. Thanks for your support. And let's talk about Poet Technologies. So here on the left, you can see their 5-year chart. It looks like it had some positive price action there. It seems to be quite volatile. And then you can see right at the end there that volume blip. On the right there, that chart shows it more clearly. That's a year-to-date chart. So in 5 days, the value of this company has increased by about 100%. So it's closing in on a $100 million market cap. So it's still a nano cap. What do they do? Well, when we look at their slide deck, we see this slide here where they refer to themselves as an integral player in the AI ecosphere. Fine. So what sort of revenues ought an integral player be pulling down in the AI ecosphere? Well, as it turns out, less than 500K this year. So this isn't a company that we would take seriously. There's nothing really to see here. Over the past 3 years, they've eclipsed $1 million barely. They have a very highly paid executive team that needs to provide some guidance to investors here on when they can expect to see meaningful revenues. And when you look at their deck, you see they talk about these advanced solutions for large tech companies. And they refer to module designs expected to be introduced to the market in 2024 and go into production in 2024, 2025. So when do you actually sell something that generates meaningful revenues? Not just the engineering work, the mini one-off projects that you've been doing. You haven't sold any product yet, at least over the past 3 years. We'll talk about that in a second. Then when you come to this other slide, they say, well, they're doing this joint venture in China and they expect to ship product for revenue in Q4 2023. Great. Then we get to this slide and it talks about their engagement with leading companies. And they have, 4 commitments there. And by the way, this is from 2021. So I don't know where the revenues have gone for these 4 committed customers. But I like this piece here on the right. It says, illustrated pipeline of customers. Illustrative pipeline. Well, I put together an illustrative pipeline of the sorts of girls that I date. Now, I haven't dated all of these girls or necessarily even some of them, but it's an illustrative pipeline, guys, okay? It illustrates the potential pipeline I could easily be attaining, and that's all you need to know there. So you look at another slide in 2021, they talk about customer wins starting now, and here, October 2021, design win and purchase order from leading systems company. Okay, coming up on 3 years later, so we should start seeing some revenues from this, right? They refer to numerous customer engagements. Then when we get to the end of that 2021 deck, I like these bullet points at the very end. They say, new product introduction commercialization stage. That's where they were at then, 3 years ago. Revenue ramp in 2022. Well, that's come and gone. Now we're in 2024. So, and you can see here also they reference the NASDAQ listing in Q1 2022. So this is simply a uplist as opposed to an IPO or anything of interest. That slide, the illustrative portfolio they showed, those 4 customers, they haven't turned into anything, but now we're turning the bend. Is that right? So you came at the perfect time. And, you can keep these stories going for a long time. I've been around the block, and I recall back in the day, you never fronted your weed dealer money. That was a big no-no, all right? You don't front money to weed dealers, and you don't front money to nano-cap stocks with grand plans. Those are 2 lessons I learned in my life. And when this company has $10 million per revenue in product revenue per annum, we're going to come back and take a look. Now, I wanted to note one other thing here. They used to have actually some decent revenues, not meaningful because they only ever hit $4.4 million, but relative to the nothing that they're putting out now, they used to have some revenues here, an actual gross margin there from a subsidiary called Denselight, and then they dumped that in 2019. So just wanted to make a note of that. Now, one thing I always do when I come across a nano cap that seems to be seeing a lot of price action is I go out and look and see if there's any paid research reports. That's a huge red flag. It's huge. And I like how Zacks small cap research here, they just took the elephant in the room and put it on the front page. So this report is sponsored, meaning someone paid them to produce this report, but it's impartial too, all right? And it's also comprehensive. So when we look at this report, which has a $5.60 price target, it says poet revenues slip indeed, but interest increases, of course. And what they use to justify that $5.60 share price target is usually some extravagant forecast, and here it is. So this year we're to expect $3 million. Hopefully we see that, right? And we'll see how it goes for the company. Next year, $25 million. The following year, $100 million. So let's hold them to that, right? So even though they've been spinning wheels for a while now, we're ready finally for the commercialization. So just some concluding thoughts here. This company is an obvious avoid until they have meaningful revenues. And to those people that will come around accusing us of being short, we never short any company, and we could care less about companies this small. The only reason we wrote about Poet is because our paying subscribers asked us to. People come by and say things like, well, in Canada, it's okay to pay for research. No, it never is. Paying for research is a huge red flag. And they may be on the cusp of greatness. That's fine. We're willing to sit on the sidelines and wait until they hit that $10 million per annum. So I'm going to go ahead and leave you with another video on a hyped AI stock, which actually has some decent revenues. And it's another good example of how AI hype can affect the price of fairly small stocks. So Thanks so much for taking the time to watch this. Please make sure to subscribe to our channel and support our work. Thank you very much.